Welcome to this week's homework, and today what we'll be doing is a bit of forecasting. Now in front of you, you see the spreadsheet that is available on iLearn, and what we'll be doing is focusing on the forecasting worksheet. So again, the structure is very similar in the sense that most of the data that we're grabbing is from the data sheet, and I've referenced everything that we need up top over here. So the structure that we have is effectively we have a number of assumptions that we need in order to forecast our financial, performance into the future. And I've divided the periods into these historical and the forecast period. So the historical ones are the ones that we can calculate in terms of the assumptions based on the past. And then the forecast is what we need to set ourselves. So in the workshop for, the forecasting, what you really need to do is be able to justify each and every one of these assumptions. Now, all of these kind of assumptions are then going to be driving the forecast that is going to be down here. So what you see down here is the forecasted figure for the income statement, the balance sheet, and the cash flow statement. What you'll notice is that, for example, the income statement has about 10, 11 line items, which means that it's a very condensed income statement. So if you were to compare it to the income statement on the data sheet, which is probably about 50 line items, it is very, very much condensed. So it doesn't have as much detail, and we're really only interested in forecasting the necessary items. We don't want to forecast each and every line item, just the ones that we'll be using later on in our valuation. So to get started, what we first need to do is we need to populate the income statement for the historical period. So I have the historical period for H&M in this case from 2011 to 2016, and all I need to do is I need to populate this area for H&M. And this area can be populated by referencing the items that I have as inputs above, and for the ones that are missing, we can usually figure them out. So for example, sales in 2011, we would then need to reference cell, C3 in this case. So it's the revenue in 2011. Now, cost of goods sold is something that we have in the cell just below, so cell C4. The gross profit, if you were to look in the input section, is something that we don't have, but we can calculate the gross profits ourselves by taking the sales and subtracting the cost of goods sold. So cell C31 minus cell C32. We then have the selling, general, and administrative expenses, and again, it's something that we don't have, but on the other hand, we do have the next line item, which is EBITDA. And again, if we wanted to figure out the SG&A, it's going to be the difference between the gross profit and the EBITDA. So again, what we need to do first is just reference the EBITDA from cell C5. And then the SG&A expenses will be the differences between the gross profit and the EBITDA. So C33 minus C35. We then go on to the depreciation and amortization expenses. And again, it's something that we don't have. But again, similar to the previous example, we do have the next line item, which is EBIT, and that's located in cell C6. So the difference between EBIT and EBITDA is the D&A, which stands for depreciation and amortization. So we can just take the EBITDA, subtract EBIT, and it's going to be equal to the depreciation and amortization for H&M in that particular year. On the other hand, we then have the interest income or interest expense. So generally speaking, most companies will have interest expenses. H&M is a bit unusual in the sense that it does have an interest income in this particular year. So you can see that whenever the interest expense is negative, it effectively means that it's an income. We then have EBT, which stands for earnings before tax, and that's merely the EBIT minus the interest expense. And again, because H&M has interest income, this number is greater than EBIT itself. We then have the tax expense, and the tax expense for H&M is equal to, 5,121, and it's in cell C8. And then finally, we have the net profit, which is merely the EBT minus the tax expense. So it's 15,821. So that kind of concludes the first year for H&M, and what we can do is we can now drag it to the right for the entire historical period. And we effectively populated the condensed version of the income statement for the period of 2011 to 2016. We then also need to calculate a number of items for the balance sheet and the cash flow statement. So again, we need to set these up for the historical period. So for the balance sheet, we need to reference the, in this case, total assets, total liabilities, and total equity, plus the amount of financial debt, so the interest-bearing debt that H&M has, and the working capital. So for total assets, we again go back to the inputs section. We find total assets in cell C9. Our total liabilities are in cell C10. And our total equity is going to be in cell C11. We then have the financial debt or financial assets. So again, whenever it's within brackets, it's going to be assets. And in this case, H&M again has financial assets. And again, whenever a company has interest income and not interest expenses, it generally means that they have more financial assets than debt. And then finally, we have the working capital, which you can find in cell C13. Press enter, and you have all the information that you need for the balance sheet section. Again, drag it to the right for the entire historical period. We then finally have the cash flow statement. So we're calculating something that's called unlevered free cash flows. And unlevered free cash flows is effectively the cash flows the firm has that is basically under the assumption that they have zero debt. And you'll understand why when we come to the, the week when we covered the discounted cash flow model. And the reason is because when you usually value a company, you usually value it on an unlevered basis. So to get to unlevered free cash flows, we usually start with the net profit of the firm, and then we work ourselves backwards. So we essentially try to add back any non-cash items and any kind of interest items. So in this case, we start off with the net profit of the year. So we start off with net profit in 2012. And again, this is something that we can only calculate for 2012 because one of the items is increase in net working capital. So we need 2 years worth of information in this particular case. We then need to have our interest expense. But what's important here is that it's an after-tax interest expense. So what we need to do is we need to reference our interest expense for the year. But then we need to multiply it by, and with open up a bracket, 1 minus the tax rate. Now in this case, we haven't actually calculated tax rate yet, but it will be in cell D23 once we've done it. So I'm just going to reference it for now. Close the bracket, press enter. We then have depreciation and amortization. And again, this is something that we can grab from the income statement. We have the capital expenditures. Now, capital expenditures not in the income statement, but it is in the inputs. So it's in cell D14. So it's 6,827. And then finally, we have the increase in net working capital, which is merely the working capital minus the working capital in the previous year. And then finally, we have the unlevered free cash flows, which is equal to the net profit plus the interest expense plus depreciation amortization minus the capital expenditures and minus the increase in net working capital. And it's 11,019. And again, this will change once we've actually added a tax rate under our assumptions. But for now, what we can do is we can just drag it to the right for the historical period. So now we have the condensed kind of income statement, balance sheet, and the cash flow statement for the historical period. And we can now start to work out some of the historical relationships amongst our figures. Now, these historical relationships will then help us to figure out what could be the future for this company. And again, you'll see that whenever we have a forecast being done, really the most important figure is usually sales growth, because almost everything else within the forecast is completely dependent upon the sales figure. So what we need to do is first to calculate a number of historical assumptions. So the historical assumptions are going to be based, again, on the historical information. So for example, for sales growth, we need to figure out the growth in the past. Now again, because it's a growth figure, we need 2 years. So we can only start this in 2012. So we're going to put an equal sign, and then we're going to open up a bracket and take this year's sales, subtract last year's sales, close the bracket, and divide it by last year's sales. And it should be equal to 9.82%. We then have the gross profit margin, and the gross profit margin is equal to the gross profit divided by revenue. So it's going to be 60.47%. EBITDA margin is very similar, but in this case we take our EBITDA and divide it by our sales. Press enter. We then have depreciation divided by total assets. So we essentially need to figure out what is our current average depreciation rate. So we're going to take our depreciation and we're going to divide it by our total assets in the same year. So cell C36 by C34, and it's equal to 5.42%. We then have our interest rate, and our interest rate is equal to our interest expense divided by our financial debt. And again, in H&M's case, it's actually income and financial assets, but it still will give us the interest that they're earning instead of the interest that they're paying. We also need to calculate the tax rate, and the tax rate is going to be equal to the tax expense in this particular year, and we're going to divide it by the earnings before tax. So it's equal to 24.45%. We then have the asset turnover, which is equal to our sales divided by our total assets. It's equal to 1.83. We then have total liabilities divided by total assets. Total liabilities divided by total assets. Next, we have financial debt as a proportion of our total assets. So we take our financial debt figure in cell C48 and divide it by our total assets in cell C44. We then have our working capital to sales, and that's merely equal to our working capital for the year. And we're going to divide it by our sales to figure out how much we have in relation to our sales on average. So it's 3.53%. We then need to do the same, but for the capital expenditures, and the capital expenditure is not something that we have for 2011. Down here, we only have it for 2012 because we're going to be grabbing it from the, cash flow statement. So I'm going to take the capital expenditure in 2012, and I'm going to divide it by the sales in that year. And it's equal to 5.65%. And now with all of these numbers, I can just drag them to the right, and I have all of the assumptions for the historical period. Now, what you see here is that some of them are more stable than others. So for example, sales growth jumps down, then up again, then down quite drastically. So it is quite difficult to figure out a general trend. So for the purposes of this homework, I'm just going to make a few very basic assumptions. So for example, I might highlight all of these all these 5 years, and I can see down here in Excel it averages it for me, and it says 11.95%. So I might say, well, I'm just going to make a very crude guess here and say it's going to be 13% for the next year, and then I'm going to assume something that's called mean reversion, and I'm going to say it's going to be 12, 11, 10, and 9%. And again, these are just guesses, and really what you want to do is you want to have an informed opinion of really what it's going to be. Now, for all the other items, again, usually you would need to quite carefully justify each and every one, but generally speaking, if I know nothing about a company, I might just take the previous year and assume it for all of the items. So I'm just going to take the previous year's numbers, and I'm going to assume that it's going to be static for their next 5 years. Again, this is an extremely crude assumption, and you shouldn't be doing this for your project. So next, what we have is the income statement. Now, for the income statement, the first item that we're going to be forecasting is sales. And the sales for 2017 is merely going to be the sales for the previous year. So previous year sales, H31. And we're going to multiply it by, open up a bracket, 1 plus the sales growth in 2017. Close the bracket, press enter, and it should be 217,262. Once we've done that, I'm actually going to jump onto the balance sheet, and the reason for that is because some of the items that we have up here will kind of depend upon the balance sheet. So I'm just going to populate the balance sheet items for now. So in order to populate the balance sheet items, I need to first figure out what my total assets are, and my total assets are going to be using the asset turnover ratio to make an assumption for the total assets in 2017. So I'm going to take my sales in 2017 and going to divide it by the asset turnover assumption that I have, and that gives me how much total assets I think I will have in 2017. For total liabilities, it's quite easy because all you need is you need to take your total assets and multiply it by the ratio that we've assumed for total liabilities to total assets. So it's going to be 42,198. We then have total equity, and total equity is merely your total assets minus your total liabilities. So it's 69,197. We then have our financial debt or financial assets, and again we take our total assets and multiply it by the assumption around financial debt divided by total assets. So it's going to be effectively financial assets in this case, and 8,030. We then have our working capital, and our working capital is going to be equal to a proportion of sales. So we can take our sales figure and multiply it by the working capital to sales for assumption that we have for 2017. And that gives us 13,152. So what we can do now is we can continue on with the income statement because we have some pieces of information that we'll need later on here. So for cost of goods sold, we don't actually have an ability to forecast this specifically. Instead, what we do is we forecast the gross profit by taking the sales for 2017 and multiplying it by the gross profit margin that we've assumed, which means that the cost of goods sold is going to be equal to the difference between sales and our gross profit. Similarly, for the EBITDA, we also calculate the EBITDA by taking the sales and multiplying it by the EBITDA margin in this case. So it's going to be 35,514, which means that the line item that's missing is merely the difference between the line item above and the line item below. So our SG&A is going to be equal to our gross profit minus our EBITDA. We then have depreciation and amortization, and depreciation and amortization is a function of our total assets. So it's going to be equal to our total assets multiplied by the depreciation to total assets assumption that we have for 2017. So it's 8,594. We can then calculate our EBIT by taking our EBITDA and subtracting our depreciation and amortization. And we then have our interest expense, and our interest expense is going to be a function of our financial debt or assets that we hold. So it's going to be equal to our financial debt in this particular year, or in our case assets, multiplied by the, interest rate that we're actually earning on them. So it's a cell I-48 multiplied by I-22. And it should be equal to negative 244, which implies that we have an interest income of 244. So our EBT is going to be equal to our EBIT minus our interest expense. And then we come to our tax expense, which is going to be equal to our EBT multiplied by the tax rate, which is in cell I-23. We then have all the information that we need in order to calculate our net profit, and that's merely the EBT minus the tax expense, and it should be equal to 21,059. So what we can do now is we can drag things to the right. Again, you'll notice there are some things missing, and those things are missing because we don't have the balance sheet items for those particular years. Once we drag those to the right, those are populated for us. So make sure that you have the same numbers that I do, and it should all be fine. We can then kind of finish everything off and calculate the cash flows for 2017 to 2020. So for 2017, the structure is going to be very similar to what we've done for the cash flow statements in the past. So again, we start off with the net profit. We then reference our interest expense, but again, when we do so, we need to remember that we're going to be doing this on an after-tax basis. We take our interest expense, multiply it by, open up bracket, 1 plus the tax rate, which is in cell, let's see, I-23. Close the bracket. So it should be 299. We then move on and we continue. Oh, sorry, I just made a mistake. So if you go back to my cell, you can actually see that I take 1 plus the tax rate. It should be 1 minus the tax rate because it's on an after-tax basis, and it should be 189. Sorry for that little mistake. We then have depreciation and amortization, which we can grab from our financial statement. So it's cell I-36. So it's 8,594. We then have our capital expenditures. So our capital expenditures can be calculated as a function of our sales. So we take our sales for that particular year and multiply it by capital expenditures divided by sales for that year's assumption. So 15,081. We then have the increase in net working capital. So we take the working capital in this year minus the working capital last year. So that should be 1,513. And then to calculate the unlevered free cash flows, we take equal to our net profit plus our interest expense plus our depreciation minus our capital expenditure and minus our increase in net working capital. And it should be 12,869. We just highlight these, drag it to the right, and you're effectively done with the forecasting section. Again, remember to go down below and answer the theoretical questions that are assigned for this particular week. Once you're done, just upload everything to iLearn.